Well, good afternoon, ladies and gentlemen, and welcome back to our Wealthi podcast. I'm Stephanie Davies, and I'm joined here by Dominic Neshi from Wealthi. Welcome, Dom.
It's good to be in the hot seat with you, and we've got these wonderful guests.
So nice to be joined by Theo Chambers and Christian Stevens from Shore Financial for our Wealthi Finance Update. Guys, thanks so much for joining us.
Thank you for having us.
I know you're very busy, lots of clients, lots of deals on the go, and we're very grateful that you've made some time today to have a chat and come in and sort of reflect on the last 6 months and of what's been happening and what we're looking down the barrel towards.
Yeah.
It's certainly been a change of pace. I know you guys went to the old studio, and it used to be you and I sitting there with like a little camera and, you know, trying to get like a light flashing on ourselves. It's a little bit different now, right?
I had to bring like a hanky in there because I was just sweat so much. It was tight space.
Yeah, there's a hot box in there.
Yeah.
Mate, what are you guys seeing in the market? I mean, it's an interesting time where the banks are doing all sorts of interesting things, and I'm hearing some are slowing up a lot. Some don't even really want to do business as much as they used to. What are you guys experiencing?
Well, it's definitely been a period that we've never been through before. But I feel like the banks have a different attitude, you know, to dealing with the economic fallout of COVID-19, differently to how they dealt with probably the GFC. You know, in the GFC, the banks were so scared about, they're so risk adverse that they were so scared of losing money that as soon as someone started going into arrears, or as soon as someone looked like they were at risk of defaulting on their mortgage, they'd step in and take action. Where here, you know, before the situation even arose, the attitude, you know, which was systemic from the government, was to make sure that you're there to help people. You know, that the banks are there to actually nurture people through this period, because if the banks step in and start being aggressive and foreclose on people's homes, it's only going to worsen the problem.
That's awesome that you said that, and I know that we've all kind of experienced this. One of the things I'm hearing from clients is, hey, I'm going to wait till September, as if the banks are all just going to shut up shop, pull their money back, and, you know, they're going to start foreclosing on loans, and there's been a lot of fear and anxiety around that. And then there's wolves sitting back saying, hey, I'm waiting to get that 20 or 30% discount. My argument has been, listen, that huge discount that you're waiting for is probably not going to come.
It's not coming.
No.
And the banks aren't going to come. What do you think, Christian?
Well, this morning they actually announced that the repayment holiday is being extended till the end of January, and I would imagine that JobKeeper will be extended next week as well, because, you know, property prices have come down. I think it's 0.8% since coronavirus started, and we won't see any 5, 10, 20, 30% drops like the media has been saying, and there won't be those huge discounts that investors are presuming they're going to get come September or early next year.
And what we've seen in the market is so many incentives to help first home buyers and first time investors get into the market, and lots of people are taking that up. Is that what you guys are seeing as well?
Yeah, definitely. Look, we definitely have a proactive government in place right now who have taken the front foot on the matter and made sure that there's, you know, stimulus packs to keep the market going, to keep the economy going. Once again, something we saw in the GFC, you know, with the first home buyers incentives back then being drastically increased, and right now, once again, first home buyer incentives drastically increased. It's looking good from a government point of view.
So sorry to interrupt you,
No,
Steph.
go for it.
What is now a good time to be refinancing? Is it harder to go and get debt, or is it easier? Because one of the things that I always pay attention to is how liquid is the market. How hard is it for me to go and get capital? Because if it's easy for people to go and get money and buy stuff, then typically that adds a bit of a floor to what property prices will do. What are you guys experiencing?
Well, I think banks have obviously changed how they're looking at income. I think they're just asking for more evidence. So if you're self-employed, they're asking for BAS statements rather than relying on financials that are a year old. If you're PAYG, they just want some more updated pay slips to show you haven't been affected by coronavirus, COVID-19. I don't think it's harder to get finance. They're just doing, you know, checking more diligently than they were pre-COVID. The biggest change I've seen in terms of assessment is how they're looking at non-base income. So bonuses, commissions, overtime, and that sort of thing. A lot of lenders have shaved, and, you know, from about 80% down to 50 and 60, which, if you know, looking at a borrowing capacity point of view, can seriously impact certain individuals. If you're in sales and that sort of thing, if you're, you know, heavily reliant on bonus and commissions, your borrowing capacity would be a lot less now than it was, say, 6 months ago. But, you know, at the same time, we've had 2 rate cuts. Interest rates have never been lower. I think it's the first time in history that we've got fixed and variable rates, both investment and owner-occupied, P&I and interest only, everything in the 2s.
Yeah.
So, for most people, they can save a significant amount of money by refinancing. That's, not including the cashback rebates and everything else that banks are throwing at customers too.
I'm glad you raised that, Christian, because a lot of clients are looking at their interest rates that they're paying. Is it too early to be locking in their interest rates?
Oh, look, anything with a 2%, in front of it is pretty attractive. And, when we first started seeing 2% interest rates, I almost fell off my chair at work. It was unheard of, 5 years to think of rates going this low. Bill Evans, the chief economist of Westpac, is now even accepting and preparing our country that we should expect to see a negative cash rate.
Really?
Which is pretty, once again, unheard of. But yeah, look, a good variable rate at the moment is about 2.6, 2.7. You can fix in at 2.1, 2.2. That's pricing in another 0.5% in cuts. So I think right now is not a bad time to fix, to answer your question.
That's scary. I've got some fixed rates now, 4 point something. Fuck.
To be honest, I'm fixed at 3.99 as well.
Oh, shit.
Yeah.
Oh.
Well, I win. I'm at like 3.91. So,
Okay.
sorry, boys.
So the shorter answer is now is a good time to have a look, do a bit of a credit check, see what your what your mortgages look like, and potentially look at fixing.
Yeah, and look, just back to your question before that Christian answered. I think that lending, you have to remember, a year ago, this time last year, we just came out of probably one of the most intense credit crunches we've had in lending and regulation of the banks, with the Royal Commission, then the federal election. And since then, there's been nothing but a loosening of lending, in the sense that rates, we've had, I think, 5 cash rate cuts since then. We've had APRA drop the assessment rate. So borrowing has actually got a lot easier. If you look at it, for the last 8 years, we're probably at the record low assessment rate, which means borrowing is at its optimal.
Yeah, that's kind of what I was alluding to, really. It sounds like some parts have gotten more difficult, so they're a bit more stringent, where they are looking at the documentation a bit more carefully, but the assessment rate has come back so much that suddenly you can go and top up and go and get some more.
Yeah, and those points that Christian mentioned are fair enough, in the sense that, of course they're going to look at someone's BAS if we've just gone through a period of someone maybe not operating a business for 3 months.
They probably should be doing that anyway.
Yeah.
Realistically.
Yeah. That's
for
what
most self-employed clients. I don't think they're asking for anything that shouldn't be asked for anyway.
And I'll tell you what, there's probably some good change coming out of this whole coronavirus, because one thing's for sure, adopting technology and software like virtual online ID is something that was embraced through this period, because banks forcing brokers and bank staff to go meet people face to face was a health hazard. But now that they've accepted that's acceptable, well, then you can't go back and change that. So I think there's going to be some efficiencies that come from this.
That's great.
Certainly. One question I really wanted to ask you guys was that as the workplace ecosystem has changed over the last 6 months, we're seeing so many different people work from home and spend more time in their houses. The government then introduced the Home Builder Grant. We're seeing lots of people spend more money renovating their home. As people spend more money renovating their home and generating equity in their homes, how do you see them being able to recycle that to lend against it and then go and invest that money?
Well, I think firstly that people, with the interest rates coming down, cash flow is going to improve. But at this stage, people are scared to do things with any of that cash flow right now. Confidence is still not 100% back to where it was, even though globally share markets are almost back to pre-COVID levels, which you'd think is a sign of confidence. People still aren't going out there and spending like crazy. Although some would argue the opposite. Some would say apparently brand new car sales last month were at record highs, which I thought was pretty unbelievable. But if people sort of saving up to do a renovation and accessing the equity and from a cash flow point of view, I don't think people are going to rush out there and realise that equity to go do something on a second purchase straight away. I think it's going to take a while before that confidence is back for them to leverage up to the 80% or whatever there is in their property value.
In saying that, sorry, Christian, I want to hear what you've got to say, but in saying what you just said, Theo, that we have seen that there is a demand that was kind of suppressed because of COVID, and it is coming back.
Pent-up demand,
Yeah, that pent-up demand is coming back. We're seeing way more inquiry in our little business, and all the agents I'm talking to are saying there's more people coming through the open houses for a particular product. And also, I think the fear that they were anticipating, all the fire sales and things haven't been there. They're actually dropping off. There haven't been any of these scary sales coming into the market. I think it was Nerida Conisby from realestate.com that reported on that recently. So,
well, I hate to keep going back to the GFC, but it's a really good reference point. If you look at the GFC, cash rates were set. The cash rate was 7.25%. Our cash rate today, 0.25%, right? And mortgagee sales, that crash in the market, those desperate sellers because they're financially, in trouble, aren't there because no one's really in pain on their mortgage because rates are so low.
Correct.
You could go rent out your property and it'll be positively geared from day one. You could borrow 105%, purchase price plus stamp duty, and be positively geared from day one with most investments you buy.
Can you get me 105% anywhere?
If you've got equity in another property, no worries. Or if you've got some rich parents, that'll help.
Christian, you were going to say something. I interrupted you.
We've obviously been quite busy, but the majority of those clientele, especially for myself, as a reference, would be for people refinancing, not for people cashing out to do a reno or to buy, but anyone that was pre-approved pre-COVID has put that on hold at the moment. They're still keen, but they're definitely, as Theo said, we're not seeing that big backlog of people jumping into the market yet. But there are buyers interested. I think clearance rates are still at record high, but that's because there's nothing available at the moment.
That's a really good point, actually. That there was a real shift in buyers in our business pre-COVID, post-COVID, as in the moment coronavirus hit, all those pre-approvals that we had sitting there ready to pounce on the market, probably 75% of them lost confidence or had a pay cut or for some reason were just on hold and no longer a pre-approval ready to go. However, that was probably equally met with refinances like Christian met or new buyers that actually saw right now as an opportunity. There's that famous saying, and right now it's actually quite literal, where they don't hold me to this one, but when there's blood on the streets, that's when you can clean up. And there's actually blood on the streets in this situation, but a lot of people thought, okay, great, there's going to be some pain in the economy. Maybe I don't have to pay record high prices and have some real estate agent claim how much I paid top dollar for the record sale on the street or something like that. I might be able to get, a 10% discount instead.
It's interesting you say that because we're not seeing many advertised, properties that are going fire sale. I'm experiencing a lot of off-market sort of, stuff that's not on the table opportunities. And I think it's for buyers that are out there who kind of need to dig a little deeper to find those deals. I can see your brain's chipping away at something. Do you two think now is a good time to be using that equity to go out and buy something, in your personal opinions?
Oh, look, I think it's a question if you think of it like shares versus property. So property is obviously a long-term investment. So, obviously you can make your money on the purchase, but I think it's more about the overall strategy and the individual, whether it's the right time to buy. Whereas with the shares, obviously it's more about the price point. So, is it the right time to buy? I think if you can find a great property at a great price, yes, but you're not going to see that big vendor discounting that everyone thinks they're going to be seeing. I think it's only about 2 or 3% at the moment. And I think, buyer confidence is pretty high. So I can't see there being any fire sales anytime soon, especially with that mortgage holiday being extended till January. I don't think we're going to see anything in September at all.
Yeah, I know we Christian and I probably both contradict what some head CBA and other banking officials are saying right now, but I actually almost think, Matt Commons, the CBA CEO, came out with some aggressive statements about the market coming off 20-30% or something like that. I think they're actually saying that to calm people down, as in don't rush out there and go too crazy. They're actually thinking of the economy and the marketplace so that people's expectations are a little bit managed and people have a bit of a conservative approach to things in the next 12 months, which I agree with.
Steph, I'm sure you always want to buy real estate.
I always want to buy real estate. That is correct. But I think having those conservative approaches may be good for some of the more aggressive investors and purchasers. I am still wondering in the back of my mind where the demand has gone. We saw last year we had the election. and a lot of people have stopped talking about it. We had the election, and then we rolled into summer, and we had the bushfires, and then we had coronavirus, and there was glimpses in there of huge buyer confidence and huge changes in the market, and then of course coronavirus hit. So I'm interested to sit back and see how that evolves over the next couple of months as well.
Definitely. Look, I think the demand is still there and strong. It's just a more cautious demand now. It's a weary and alert demand, and there's still a housing shortage, right? There's still a situation where we don't have enough houses to supply the people that want to live here, and the supply of houses is eased even more. I think last time we had one of these chats, Dom, that we were talking about the housing shortage and the supply easing. It's only gotten worse, that problem.
Come on, 30-40%. It's getting way worse. Developers are finding it harder to go get funding. They're sitting on residual stock, and they're just like, well, I'm not in a hurry to go start a new site. It's hard. It's hard out there, and I don't see any. It's not going to get any better anytime soon. It's a very interesting part of the market. I think that there's a few things that I like to pay attention to. It's one, how easy is it for you to go and get money? And then what is the government doing? Typically when they make regulations hard, the market then, suppresses. When they ease up the regulations and they support buying a property, that's when you see the property prices move. So interesting times. I'm sure that we can sit and talk about this all day, and we'll probably have to save it for the next podcast, but
Guys, it's been so great chatting to you. Thanks for joining us.
Thanks for having us.
I've made some take-home points. So it's been great to chat about the banks, chat about lending. It's a great time for clients to be refinancing and coming to speak to you guys about their options and how to do that. Housing supply and the property market generally. It's been really wonderful to chat. One more question for you, Theo. I asked Christian already in our first home buyers chat, but what does wealthy mean to you?
I think wealthy means when you can live month to month with all your living expenses and not be so concerned about having to meet those living expenses. So live the lifestyle that you want to live without having the stress of meeting the financial requirements of that lifestyle. So passive income is a clear way to get to that, and a clear way to get to passive income is probably property investment. But yeah, that's probably my definition of wealthy.
We didn't pay Theo to say that, by the way.
No, and I'm just thinking maybe I need to tailor that question a little bit more personal. There's a theme coming out here, and that was not my intent. All right. Well, anyway, guys, thank you so much for joining us and coming in today.
Thanks,
Thank you.
See you guys.
Should we get this photo now?
I didn't know if wealthy you meant with the brand or generally wealthy.
Sorry, I should have told you.